Hi everyone, welcome again to RHB Assets Management podcast series. I'm Fauzi, Chief Investment Officer, Equity Malaysia. As we know, Malaysia has high numbers of new COVID-19 cases since the beginning of this year and is now among the top 10 in Asia with highest number of COVID-19 infections. The government has re-implemented movement control order from January and tightened it further from 1st June in order to contain the numbers from rising further. The high COVID-19 cases and the re-implementation of the movement control order has led to the FBMKLCI Index underperforming its regional peers year to date. Malaysia, Indonesia, and Philippines are the three worst performing index in the region and coincidentally are the countries with high infections numbers. On the other hand, the North Asia equity markets performed strongly due to better economic growth prospects. The North Asia market is attractive compared with ASEAN market due to the expectation of strong corporate earnings growth. North Asia market become more attractive now as the financial market is expecting that the current high US inflation rate will come down in the future. Hence, companies in North Asia are expected to maintain their strong earnings growth. We noticed that only the short-dated US government bond yield moved up after US Federal Reserve made the statement that they are prepared to raise interest rate earlier than previously expected. However, the long-dated US government bond yield has come down. This has flattened the US government bond yield curve as the earlier hike in the interest rate will diffuse the inflationary concerns that drove up the longer-dated yields previously. Nevertheless, we believe that the long-dated US government bond yield will still go up later as the US economy grows. Despite the high number of COVID-19 cases and the re-implementation of stricter movement control order, the FBMKLCI Index seems to be holding well. Although the total lockdown will have a negative impact on the economy, it is not going to be as bad as during MCO 1.0, where Malaysia GDP shrunk by 17.1% in the second quarter of 2020. The slowdown in GDP is likely to be supported due to the strong export performance and the stimulus packages that the government introduced, as well as the government is also accelerating the vaccination program. We are of the opinion that the investors are looking beyond the short-term weakness and focus on the long-term story of economy reopening should the government succeed in reducing the number of new COVID-19 cases and achieving the target vaccination rate. Unlike MCO 1.0, the corporate earnings estimate does not suffer major downgrade. The corporate earnings have only been downgraded by only 3.6% since the announcement of movement control order, which is not as steep as the downgrade during MCO 1.0. However, we would expect corporate earnings to be downgraded further as the stricter movement control order will slow down economic activities and banking sector's earnings are expected to be downgraded due to the reintroduction of the 6-month loan moratorium under Pemulihan stimulus package. Besides the reduction in the number of new COVID-19 cases and the successful implementation of the vaccination program, corporate earnings growth is key to the performance of the index going forward. To conclude, whatever concerns there may be about the COVID-19, especially new variants and the slow pace of the vaccination program, we are of the opinion that the corporate earnings might not get downgraded as bad as it was in the second quarter of 2020. The optimism on equity market will get better as more people get vaccinated from July and if the number of new COVID-19 cases reduce significantly. In addition, US inflation is expected to be under control as US Federal Reserve is prepared to hike interest rate earlier than expected, and this will be positive for corporate earnings growth to continue its uptrend. We would expect the index to consolidate within narrow band with downside bias in the short term. We will stay with defensive sectors until infections peak and economic activities recover. However, the risk to our corporate earnings and market optimism will diminish if the full lockdown is prolonged and if the government's projection of reaching 80% vaccinated nations by first quarter 2022 face further delay. Another concern is when US Federal Reserve start to taper as inflation and economy improve, but so far there is no indication as to when it will begin cutting back on its aggressive bond buying program. Lastly, our optimism on earnings momentum may have peaked if economy continues to stall. The market sentiment will be negative if peak earnings growth momentum coincide with an actual US Federal Reserve tapering, and this will be very challenging to equity market if it happens towards the end of the year. Thank you.